Hello, Tim Kerrin here from Mortgage Choice in Kingsley. Today it's early to mid-August, it's actually the 9th of August at the time of recording this, and wow, a lot has happened in the last few months. A lot has happened in the last few years, but a lot has happened in the last few months that I need to bring you up to speed on. So, first of all, as I'm sure you know, we had a Royal Commission earlier this year, and then the Liberal Party won the election, which meant the mortgage broking industry didn't get destroyed, which means I'm still here, which is something I'm very grateful for. What followed on from that is, what I believe is following on from that, in summary, is hopefully a period of stability, and I'm seeing policy changes and rule changes from government and lenders that are opening up opportunities for people, and I just want to discuss a few of those. So probably the most obvious one is that the Reserve Bank dropped interest rates twice in the last 2 months, and that's had an impact on what people can do. It's had an impact on the cost of buying a property, the cost of an investment property, for example, and it means your repayments are going to be lower, which means there's more opportunity out there. That's important, and it's resulted in the next thing, which is lenders dropping not only their variable rates, which happened in all cases within about a month of the Reserve Bank making the announcements, and on average I would say lenders have dropped rates probably 0.4 to 0.45% all up across those two drops, which is significant. But also fixed rates have started to drop as well, and we now have a couple of lenders with fixed rates starting with a 2. I don't think I ever thought I was going to see interest rates that start with a 2, but that's what we're down to. 2.99% is a fixed rate you can get right now in the right situation. So rates are low. That on its own doesn't mean your borrowing capacity is higher, because lenders until recently have been required to assess home loan applications as if the interest rate was going to be 7%, and most of them have chosen, for as long as I've been a broker, to use 7.25. So even if your interest rate is 5% or 4% or 3% or 2%, a regulation has been requiring lenders to assess it as if it's 7.25%. And that's meant that dropping interest rates doesn't improve your borrowing capacity. However, and most importantly at the moment, what's really exciting, I think, is that APRA, the Australian Prudential Regulation Authority, that tells banks a lot of what they're allowed to do, has just changed the rules on that. There is no longer a minimum assessment rate on a home loan. Lenders no longer have to assess a home loan as if the interest rate on it is going to be 7.25%. They're now only required to make sure there's a 2.5% buffer above the actual rate. And what that means is lenders are now adjusting their policy to assess loans at around 5.5%, give or take a little bit. And that, I think, is improving people's borrowing capacity by anywhere between about 8 and 20%, depending on the situation and the lender. So people are able to do more than they were a month ago. People are able to borrow more than they were a month ago. And this is happening at a time, I think, critically, where a lot of self-employed people, and self-employed people are homeowners too, have gone through a really tough period where they haven't been able to demonstrate their borrowing capacity because business is tough and they've made a loss over maybe 2014, 2015, 2016. They're just at the point where they're starting to get maybe 1 or 2 tax returns, 1 or 2 years of finances to show that business is going okay, and they know they're good, and they want to borrow some money to invest in their business perhaps, or buy a nicer house, or consolidate some of the debt they had to, some of the credit card and personal loan debt perhaps, that they had to get while times were tough. And we're just at a point now where this borrowing capacity boost, in combination with them having good financials, should mean a lot more self-employed people are able to borrow money. And lenders are starting to relax some of their policies around that as well, making more and more things possible. So I actually feel really excited about the opportunity for people across Australia and in Perth, where I see so many people have been doing it tough for the last 5 or 6 years. I think there's opportunity now to have a better outcome. There's opportunity now to do what perhaps I might have told you 2 months ago you couldn't. Well, 2 months ago I knew this change was coming, and I was talking about what was possible. So if you think you can't do something because maybe 12 months ago I told you you couldn't, it's definitely worth reassessing now, because the way the world works, the way the world of finance works, has changed significantly. For what it's worth as well, the other probably final piece is we had a brand new banking code of practice come into play on the 1st of July, which has changed what banks are doing and how they're treating vulnerable people, Indigenous people, rural people. There's a lot higher standard, and I read right through the code myself. There's a lot higher standards being applied to how banks treat people. And to me, that sounds like a really good thing too. So there's plenty to talk about, most significantly your borrowing capacity, and if you're self-employed, the possibilities for what you can do now are different to maybe what we've talked about in the last few years. So we should talk about that again. Thanks very much.